Hello and welcome to the download. I'm your host, Dave Richardson, and it is time to travel somewhere where many of us never go, particularly not from an investment perspective, but we should. And we have I'm not going to say one of our favorites, because I'll just give you the name that I use for him, and then you'll know where he sits in terms of my view of him. And we call him Phil the Thrill. And that is Phil Langham, who is the head of Emerging Market Equities at RBC Global Asset Management. Phil, Happy New Year. Great to see you. You look fantastic. You had a great year. Is anyone having a better time right now than you, Phil?
No, I mean, I can't complain. It's been a really good year in emerging markets. So emerging markets overall were up in US dollar terms 35% and strong outperformance of developed markets. So yeah, I'm definitely very happy at the moment.
And I'm happy because my wife was looking at her portfolio. She invests with you, and she had a big smile on her face, and she had a big smile on her face, and she was with me. So this is unusual, Phil. So you're doing something right. So when you look back at 2025, Phil, what drove the great returns in emerging markets?
I'd say it was a combination of multiple expansion and earnings growth. Valuations in emerging markets were extremely cheap. We've seen emerging markets underperform for several years now. And in the last 2 or 3 years, we've started to see much better earnings growth coming from emerging markets. What I would say is that if you look at the performance of emerging markets compared to developed markets, historically it's tended to occur in very long cycles, typically cycles of 8 to 12 years. We've just come through a very long period of emerging markets underperforming. And although last year looks extremely strong, if we look back at performance over a longer period of time, really it was just a blip. And it would feel that if we judge what's happened historically in emerging markets, we can expect there to be much more upside going forward.
Yeah, and that's I think that was a really important thing to add, because we've seen, I guess, and really what would be the starting point? 18 months ago, Phil, or almost 2 years, where you saw the transition between the relative performance of emerging markets move ahead of that of the US. Would that be the time
I'd
frame?
say probably not even quite as much as eighteen months ago. We saw the US market uh, peak as a percentage of global market cap in December 2024 at around 67%. It's currently at about 64%. And if you look at it 12 years ago, it was around about 40% of global market cap. And since then, we have seen non-US markets, and particularly emerging markets, start to break out in terms of overall performance.
Yeah, and only just a touch over a year into that better relative performance. And again, when these things reverse, they tend to hold, as you mentioned, for an extended period of time. Now, that doesn't mean that every year through that extended period, emerging markets will do better than the US or do better than Canada, but it'll be a trend over time. So you went from 40% up to 66% of the global markets being U.S. weight, and now you've started to see the U.S. start to move back down, and again over the long term, you'd expect that to kind of normalize back towards its longer term trend, which would be right around 50%, right?
Yeah, I'd say, I mean, it came from 40%. And I think just thinking about it, 67% of all global market cap in one market is clearly extremely high, and valuations in the US, look very elevated relative to history. I think another way of thinking about it would be that for most investors, they'll tend to have something like 5 or maybe a maximum of 10% of their assets in emerging markets. But emerging markets overall, broadly constitute something like 50% of global GDP, and something like 70% of global GDP growth, 80% of the global population. So overall, people have relatively little invested in emerging markets compared to the size of emerging markets.
And so if we look back at 2025, and you say it's a case of a multiple expansion and earnings growth, were there any areas of emerging markets in terms of geography or sectors that were particularly standouts through 2025?
It was very broad-based. Like developed markets, we saw the IT sector leading, but I'd say the performance in the IT sector wasn't as dramatic as it is in the developed world. And if you look at valuations of IT, again, they're high in emerging markets, but far from extreme and much lower than they are in developed markets. But we also saw domestic sectors be relatively strong. So sectors such as financials and the consumer. And to us, these sectors actually look really attractive going forward. And again, we started to see some of the commodity sectors more towards the end of the year do well. Not so much energy, but more areas such as materials. From a country point of view, we've seen China be quite weak until the last 18 months in the last few years. But China's started a much stronger period of performance. We've also seen the other North Asian markets, so Korea and Taiwan, be relatively strong. And for the most part, we've seen strength across the board. One market that did lag last year, but has been very strong over the longer term is India. Really, the key issue in India was valuation. So India had performed very well for the 3 or 4 years coming into last year. Yeah. We still feel that India has a very strong structural growth story, likely to be the fastest growing emerging markets, and lots of great companies. Penetration in India in a large number of different areas is still very low, still growing. Urbanization is still growing. The demographic story is still very strong. So we're positive on India over the long term. We did move to being slightly underweight, and we're now looking at India and looking at some increasingly attractive assets in India, and we're likely to increase our weightings in India over coming months.
So that does sort of transition us into 2026. So India is an area, again, after having a relatively weak year due to valuation, year of going kind of sideways, makes it more attractive as you come into 2026. Anything else that you're looking at in 2026, again, either geography or sectors of the economy that you think are going to be particularly are areas of your portfolio where you might be looking to be overweight as you go through the year?
Yeah, I'd say from a sector point of view, we've always liked domestic sectors, so sectors such as the consumer and financials, but we feel even stronger about that now. I think with the tariff regime that's in place, we're seeing emerging market countries focus much more on domestic demand. We're seeing we do feel that valuations in those areas are very good. Interest rates are likely to come down, again, supporting domestic demands. And I'd say we have some concerns on some of the other areas that have done well. So IT in particular. Uh, we feel that over the next 1 or 2 years, we're likely to see investors increasingly question the huge amounts of capex that have gone into AI, the returns that as yet we haven't really seen, the increasing competition, the increasing leverage, the very high valuations in those areas. Now, emerging market companies have largely benefited in those areas by being essentially the picks and shovels, so the leading semiconductor companies. But certainly if we were to see a correction in IT and AI stocks in particular, we feel that emerging market IT companies would not be immune from that.
Yeah, I want to talk about an area again that I know you like, and you've already mentioned, which is the financial sectors. And again, those are, as you say, are more domestically focused. And Canadians would be very, very familiar with the Canadian banking system, as most people are familiar with their own domestic banking system. And you tend to think that the rest of the world looks like that. So Canada, there's if you go to the downtown core of any city in Canada, there's a bank on every corner. There's lots of branches all over the place. There's a small number of very successful banks, and there's other options as well, and some emerging options online. But everyone has a bank account. It's a very strong bank culture in the country. People trust, rely on banks. Have certain expectations of what they're going to get out of their banks. But if I go to an emerging market country, say I was to go to, I don't know, Bangladesh or Peru, what would I see that was different in the banking culture there than what I would see in the UK where you live, or in Canada where our listeners live?
Well, I'd say in countries like Bangladesh or Peru, the standout difference would be that credit penetration is much lower than it is in the developed world. So in Peru, for example, credit penetration is something like 20% of GDP. It would be sort of 4 or 5 times that in the developed world. If you look at mortgages as a percentage of GDP in a country like India, they're around 9%. They're 25% in most emerging markets and 80 to 100% in most developed markets. So credit penetration would be the standout difference. I'm not sure whether, to what extent this is the case in Canada, but it's definitely not the case in a lot of developed markets. But one thing that we do see in emerging markets is that the very best banks are really able to maintain their competitive edge over long periods of time. And what we found is that there are perhaps 2 key factors that really determine that competitive edge. The first one is your deposit franchise. So to what extent do you have access as a bank to low-cost deposits? And the banks that have the highest access to that tend to be extremely successful, and it's not something that is easy for other banks to gain market share on. Yeah. The other thing that we feel is important is, in terms of management, having a prudent approach, a focus on credit quality. And again, that's something that tends to be part of the culture of banks. And those banks and those management and owners that really focus on this over the long term have tended to be much more successful. And therefore, what we've seen as a result is that the very best banks in emerging markets are able to produce the highest return on assets over very long periods of time.
Yeah, and I should say, listeners might say I'm obviously biased because I've worked for a bank for 34 years. So when I say banks are trusted and loved, and that maybe I'm showing my bias, but at the very least, there's a stability and a power in the perception of that particular institution, which, as you say, draws assets in so that they can be lent out, which is basic banking. And what's exciting when you talk about these other countries, and if you put your Canadian banking hat on, is that lack of penetration. That as these countries continue to emerge as they are, and if you spend any time as you do in emerging market countries, as you've been traveling the emerging markets for what, Phil, 30 years?
Yeah, 33 years. Yeah.
33 years. I mean, when you go to again, we pick any country, you go to Vietnam today versus Vietnam 30 years ago, there is a distinct difference in what you see in terms of infrastructure, in terms of modernization. And if you just apply those same things to financial services, that's where you can get pretty excited about the financial sector in emerging markets.
Yeah, I'd say, I mean, the financial sector in emerging markets is still very much a growth sector. Penetration is still growing. Clearly, it's much more mature in the developed world, and we're actually, for the most part, seeing branches close and online competition. That's not the case in emerging markets.
Yeah. So Phil, the other one of the concerns that investors express to me when they start to think about investing in emerging markets is, and perhaps we've seen a glimpse of it right here, is the political stability or the influence of geopolitics on smaller economies, smaller markets, and the U.S. action in Venezuela is an example of what the perceived risk that Canadians would have investing in the emerging markets. When you're thinking about the companies you're investing in or countries that you're going into, is that something you're considering? Obviously, it's not something you can predict perfectly, but is that something you take into account? What the political situation is and the potential for issues that could spurn from a developed economy?
Yeah, absolutely. So perhaps the best example for us would be Russia. So we didn't have anything at all in Russia going into the Russia-Ukraine crisis. Now, obviously, we didn't predict that Russia would invade Ukraine, but we did recognize very high political risk in Russia under Putin. The fact that goalposts could be changed, the fact that he had a huge influence, and despite the fact that Russia was a meaningful part of the overall index, we still had a zero weighting to Russia and had a zero weighting for several years. So it is something that we think about and that we feel is very important. I'd also say, just as important, if not even more important for us in terms of looking at overall countries, is looking at overall companies and management. And we spend a lot of time on corporate governance. For us, it's an absolutely key part of what we look for in the companies in which we invest. We want the very best corporate governance, management that we can trust, owners that we can trust, and we won't put our clients' money in any companies where we feel that's not the case.
Yeah, and I mean that's something that you're looking for in developed markets as well, because companies that have good governance, treat their employees well, treat their customers well, treat the environment well is another connection which would surprise people. But it's got to be even more important in emerging markets because the disparity between the best and the worst is probably larger than what you'd see in developed markets.
Absolutely, that's the case. So for us, that's been, I mean, people have been more focused on that in the last few years, but for us, that's been an area where it's been absolutely instrumental ever since we launched the strategy 16 years ago. And you're right that it's important whatever company you look at, but it's particularly important in emerging markets.
Has that been really the key to your success? Just that, uh, or the fact that again you and the team hop on planes and travel all over the place to go and not just read about how good a company might be, but actually go and look them in the eyes and see them, and then the depth of experience. What do you attribute the success that you've had around emerging markets over an extended period of time, Phil?
Yeah, I'd say you're right in terms of the philosophy. So spending a lot of time on management, on owners, on people that we trust, and I'd say in general the research that we do as a team. So on the on ground research, but also a lot of the sort of top down reports that we do from a sectoral and thematic point of view. And the detailed work that we do, meeting companies, meeting different layers of management, meeting industry experts. So for us, research is absolutely crucial. And when it comes to research, we do not cut any corners.
Yeah, and that's if the listeners are wondering why I kind of threw out the relative situation of banking in Canada versus Bangladesh and Peru. I knew that Phil would know the credit penetration of in Bangladesh and Peru just off the top of his head, which speaks to the kind of depth of knowledge you really need to invest in these areas successfully, because again, there's all kinds of opportunities out there, but and there are in developed markets as well, you would say this, but there's always landmines out there. Maybe a few more landmines out in emerging markets than in developed markets. So that expertise and knowledge right down to the local level is really important to drive sustained success investing in emerging markets.
Yeah, absolutely. I mean, it's something that we as a team have been doing for 16 years. As you mentioned, I've been doing it for 33 years. And when I first started doing emerging markets, it was actually a really small asset class. So
yeah,
I've seen very, very significant changes over the last 3 decades.
Yeah, it's really amazing, and as you can tell we're on YouTube, Phil, so they're seeing it on video, and we've got the podcast on audio. By the way, subscribe and follow us on YouTube. Give us a 5-star review, because Phil is certainly a 5-star investment manager. But you can see he's the humility. He's such a humble man for the success that he and his team. And I know you attribute everything to not just yourself, but the entire team you work with. And we've had Laurence on the podcast, your colleague, as well. But that's why his many fans, certainly internally, call him the Thrill. So and I know again that just makes you blush, but Phil, congratulate. I know even though in relative terms you were doing very well through some of the tough years on a broader relative basis for emerging markets, but it's a lot more fun when the wind is at your sails instead of in your face.
Yeah, absolutely. So yeah, hopefully that will continue.
Great. Well, Phil, thank you so much for the time today. Always great to catch up with you. And again, just another example as we go through all of these different markets and we look back at 2025 and look forward to 2026, that diversification, not getting stuck in the mindset that just because over the last year something's underperformed that it can't do well the next year. If you were thinking only that way, would have been in the overweight US and not touching emerging markets last year, would have been exactly the wrong thing to do. But when you go into emerging markets, it's good to have a guide like Phil who knows his way around. And so I'm glad you're taking care of my wife, much better than I probably do.
Thanks, David.
Thanks, Phil. Yeah,
Good
thanks a lot. We'll see you.
Thank you.
We'll see you soon. Take care.
See you soon. Bye.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.